ready to tap into some wisdom that's truly stood the test of time. We're diving deep into The Intelligent Investor today.
Ah, a classic.
It really is, over 70 years and still so relevant. It's amazing how Benjamin Graham's principles just don't seem to age, even in today's market, which moves at what feels like a million miles an hour.
It's true.
And I know our listeners, you're all about getting that solid knowledge base without being overloaded, which is exactly what this book's about, right?
Yeah.
It's about building that strong foundation so you can make smart decisions. And the best part, it's not about trying to memorize some crazy complex formulas.
No, not at all.
It's about mindset
Absolutely.
and temperament. Would you say that's accurate?
Yeah. Yeah, I think what's really fascinating about Graham's approach is he doesn't define an intelligent investor
Yeah.
by, how good they are at doing these complex calculations or how they can outsmart the market.
Yeah.
It's more about character, really.
Yeah.
He really emphasizes those qualities,
Yeah.
discipline, patience, emotional control. He says that's the real foundation.
I love that because I know I've definitely fallen into that trap of thinking, oh, I've got to outsmart everybody else in this game.
Yeah.
And it's exhausting.
Right.
It can really burn you out. So to hear it's more about temperament, that's refreshing.
Yeah, and it really comes down to, are you building a strategy that actually fits you? Your personality, how much risk you can handle.
Exactly. So speaking of that, have you always seen yourself as a hands-on investor? Or do you lean more towards hands-off?
It's a great question and really gets to the heart of it because I think understanding your own investing style, that's paramount. Figuring out, are you someone who enjoys digging into the nitty-gritty of a company's financials? Do you like actively managing everything? Or are you more comfortable setting a long-term strategy and letting it do its thing?
Right.
And the great thing is the intelligent investor has something for everyone, no matter which way you lean.
Okay, so let's dive into one of Graham's big ideas here. That difference between investing and speculation. He's got this analogy, and it's brilliant, about a casino.
Oh, yeah.
Yeah, he says investing is like walking into a casino where you're guaranteed to win, as long as you stick to the rules. Speculation. That's you betting against the house. And we all know the house always wins.
Wow.
Right. Powerful analogy.
Yeah, it really makes you think. So you're saying with investing, it's about doing your research, really understanding what a business is truly worth,
Exactly.
and not just jumping on any opportunity. It's about being patient, waiting for that right moment when the price is right. Am I getting that right?
Absolutely. You hit the nail on the head.
Okay, got it. So it's a long game then. This isn't about getting rich quick. It's about steadily building your wealth over time.
That's it. And speculation, well, that's all about chasing those hot tips and trying to time the market just right, which we've talked about before.
Yeah,
Easier said than done.
right. It's like trying to catch lightning in a bottle. Not easy.
I've definitely had those moments, where I got caught up in the hype. You think you're going to get in on the ground floor of the next big thing,
Oh, tell me about it.
and then poof, gone, vanishes into thin air.
It happens to the best of us. I think that's such a good reminder, though. Speculation, it might seem exciting on the surface, but often it's a recipe for disaster. You're more likely to end up lining Wall Street's pockets than your own.
So true. It's easy to get swept up in it all, but Graham, he doesn't shy away from those dangers.
Yeah.
He talks about the dot-com bubble, remembers those days.
How could I forget?
And he uses this company, VA Linux, as a prime example.
VA Linux, what happened there?
So this company, they went public. And get this, they had zero earnings.
Whoa.
Zero. But their valuation, through the roof, all hype.
Wow. Just goes to show you the power of, well, I guess you could say irrational exuberance.
That's a nice way to put it.
People got caught up in the frenzy, and when that bubble burst, well, let's just say a lot of people learned some hard lessons that year.
VA Linux, talk about a cautionary tale. I mean, it really highlights how easily emotions can take over.
Oh, absolutely.
Especially when everybody else seems to be making money hand over fist. You feel like you're missing out if you're not in on it.
It's that fear of missing out, right?
Exactly. And that's when we tend to make those not so smart decisions.
That's true.
So how do we avoid those pitfalls?
Yeah.
Because Graham, he offers some really solid advice, practical strategies for building what he calls a defensive portfolio.
Right, and that resonates with what we've been talking about, right? This idea of taking a long-term approach, not trying to time the market perfectly.
Exactly. So tell us more about this defensive portfolio. What's the core idea there?
Okay, so with a defensive portfolio, it's all about that solid foundation. You're prioritizing stability, steady growth, not those like dramatic ups and downs. You're not swinging for the fences with every single investment.
I like that.
Yeah, and Graham, he emphasizes two things: simplicity, keep it straightforward, and diversification.
Don't put all your eggs in one basket.
Precisely. He actually suggests starting with a portfolio of stocks and bonds, and he even gives you a starting point.
Oh, does he? Okay.
Yeah, he suggests a 50-50 split.
Okay.
So half in stocks for that growth potential and half in bonds for stability and income.
That makes sense. It's about finding that balance. But then how do you actually manage that portfolio, right? Are you constantly having to buy and sell to keep it at that 50-50?
Well, that's where another one of Graham's, I think, brilliant strategies comes in. It's called dollar cost averaging. And what I love about it is it takes so much of the emotion out of investing.
Well, I like the sound of that already.
Yeah, it's all about staying disciplined. So basically, you're investing a fixed amount of money at regular intervals, and here's the kicker. You do it regardless of what the market is doing.
Okay, walk me through that. Let's say, for example, I decide to invest $500 every month.
Perfect example.
So some months, the market's up. My $500, it doesn't buy as much.
Right.
But then other months, when the market takes a dip, boom, my $500, it's buying me more shares.
Exactly. You've got it. It's automatic. By investing consistently, you're naturally buying more when the price is low, less when it's high. It just takes the guesswork out of it.
I love how simple yet effective that is. You're not trying to outsmart the market. You're just staying consistent.
Precisely. And that's the beauty of so many of Graham's strategies. They seem almost too simple, but they work. And you know what else I love about Graham? He doesn't take himself too seriously.
Oh, sure.
Yeah. Have you seen the investment owner's contract in the book?
No. Tell me more.
It's great. It's this little agreement you make with yourself, a reminder to, like, not get caught up in the hype. It's a way to stay focused on the long game.
I love that. It's like your own personal investing constitution. You can always go back to it, especially when the market's doing those crazy swings and you're feeling tempted to make a rash decision.
Exactly. Because we're all human, we're going to feel those emotions. This just helps you stay grounded.
For sure. Now, we've been talking a lot about the defensive investor. What about those listeners who are a little more hands-on, who want to be more actively involved in managing their investments? Graham calls them enterprising investors. What does he have to say for them?
You know, he definitely acknowledges that some people, they have the time, they have the interest, and maybe even the personality for it to really dig in and be more active with their portfolio. But he starts off with a big caution.
Oh.
Yeah, he warns against trying to predict the market.
Oh, I bet that's a tough pill to swallow for some.
It is. But he emphasizes even the experts get it wrong all the time.
And not just a little wrong sometimes.
Sometimes with, like, disastrous results. He uses the example of Alan Greenspan.
Oh, wow. Okay, so we're talking about the former chairman of the Federal Reserve.
Right.
If anyone would be able to predict the market.
Right. You'd think it'd be him.
Exactly.
But even he made this really bullish prediction in 1973, and guess what? The market crashed.
Wow. Talk about a reality check.
It really makes you realize how difficult it is, maybe even impossible, to consistently time the market perfectly, no matter how much experience or knowledge you have. So instead of focusing on that, Graham says, hey, enterprising investors, if you really want to get hands-on, focus on this, identifying undervalued companies.
Okay, so we're talking about finding those hidden gems in the market, right? Those companies that are trading for less than they're really worth.
Sure.
But how do you actually go about doing that?
Right. He says it's about really analyzing a company's fundamentals. You've got to dig into the financials, look beyond the surface.
So you're really getting to know a business inside and out.
Exactly. Look at their earnings, revenue, cash flow, management team, competitive advantages.
It's more than just looking at a stock price, isn't it? You're really trying to understand the underlying business.
Precisely. And what are some of the things to look for when you're analyzing those financial statements?
Well, one of the most important things is consistent profitability. Don't get distracted by one-time events or accounting tricks. Look at the trends. Are their earnings growing steadily? Is it sustainable?
So it's not just about how much money they're making today, but whether they can continue to make money in the future.
Exactly. It's about understanding the long-term potential.
It's like looking for a company that's built to last, not just one that's, here today, gone tomorrow.
Okay, so we've talked about financials, but a company is more than just numbers on a spreadsheet, right?
Absolutely. There's that human element, too.
Yeah, a company is more than just numbers on a spreadsheet.
Right.
The people running it, they make a huge difference.
Huge.
So what should we be looking for in a management team?
Well, you want to see a track record of honesty, competence, and are they shareholder friendly?
Okay.
Do they have that long-term vision?
Yeah.
Are they good stewards of capital?
So because it's easy to grow a company quickly,
Yeah,
but are they doing it sustainably?
exactly. And those qualitative factors, they can be just as important as the numbers.
Absolutely. So we've been talking about Graham's principles, but how do they apply in today's market?
Good question.
I mean, the world moves so much faster now.
It does.
Can these ideas from the 1940s really hold up in the age of algorithms and instant information?
That's what's amazing about Graham's work. His principles, they're timeless.
Mm.
And that's because they focus on those fundamentals of investing.
Yeah.
They're not about chasing the latest trends. You know what I mean?
It's about the fundamentals.
It's about adapting, not abandoning.
So not throwing out the rule book, but learning how to apply those rules in a new context.
Exactly. For instance, that idea of margin of safety that Graham talks about.
Yeah.
That's crucial in any market,
Especially one as volatile as ours.
especially one as volatile as ours. It's about protecting yourself from the unknowns.
Right.
Buying assets for less than they're actually worth. It's like having a buffer.
That makes sense.
Yeah.
Can you give us an example of what that looks like in practice?
Sure. Let's look at one. Graham talks about the Washington Post Company back in 1973.
Okay.
So at the time, they were trading for around $80 million.
Okay.
But when you looked at their assets, those assets were worth at least $400 million.
Wow. So the market was valuing the company at a fraction of what it was actually worth.
Exactly. A huge discrepancy between the price and that intrinsic value.
That's incredible.
And that's a classic margin of safety opportunity. Investors who recognized that and had the courage to act, they were rewarded big time.
It's amazing how these opportunities exist if you know what to look for.
Right. And that's the question every intelligent investor should be asking.
What's that?
How can I apply these principles to my own investment?
That's the million-dollar question.
Right. What are your goals? What's your risk tolerance? What kind of investor do you want to be?
Those are great questions to think about as we wrap up this deep dive. It's a good reminder that investing, it's not about getting lucky or chasing the next big thing. It's about approaching the market with a long-term mindset, being a little skeptical, and really understanding those businesses.
Couldn't have said it better myself. And remember, the intelligent investor, it's not a one-time read. It's something you come back to again and again.
It's a lifelong journey.
Exactly. You learn something new every time, and that's what makes it so valuable.
Well said. I want to encourage all of our listeners, pick up a copy of The Intelligent Investor if you haven't already. Start exploring these timeless principles. And remember, invest intelligently, build that wealth steadily, and most importantly, enjoy the journey.
Hear, hear.